Welcome to Breaking News to Trading Moves. Today we're putting you right in the middle of a multi-billion-dollar industrial reality check.
Yeah, and it's a massive one.
Right. So imagine taking delivery of a brand new state-of-the-art computer processor, but it runs so relentlessly hot that you require an industrial-grade refrigeration system.
Like something you'd normally see cooling a massive food processing plant.
Exactly. You need that just to prevent the silicon from physically melting. And that is exactly the scenario playing out in the tech world right now.
It really is.
And we're looking directly at an announcement that puts a hard dollar amount on this problem. So Modine Manufacturing has announced a long-term agreement to supply more than $4 billion worth of Airedale data center cooling products.
Which is just a staggering number.
It is. This contract runs from 2027 to 2029, and it specifically includes upfront funding to support capacity expansion.
You know, that headline gives us a perfect map for our mission in this conversation.
Okay, lay it out for us.
We are examining this $4 billion cooling contract to identify the clear winners and losers across various sectors. Because the reality of an AI data center is that it requires far more than just graphics processing units or GPUs.
Right, it's not just the chips.
Exactly. To operate at scale, these facilities demand heavy power, specialized cooling, complex electrical systems, massive grid upgrades, networking, even just raw construction.
So we're really evaluating how a multi-billion-dollar commitment to one piece of that puzzle, the thermal management, impacts the rest of the board.
That's the goal.
Well, let's begin right where that cooling hardware physically sits, looking at the direct winners in thermal management.
Yeah, the companies directly making the gear.
Right. The companies identified in this direct winner group are Modine Manufacturing, trading under the ticker MOD, Vertiv, ticker VRT, and Carrier Global, ticker CARR.
The core logic here is that AI servers generate heat at a scale that traditional data centers simply weren't built to handle.
Which is why Modine is the headline name, right? Securing a $4 billion deal gives investors immediate confidence that its cooling business can successfully scale up.
Yeah, but Vertiv and Carrier also benefit from the reality that cooling is becoming the primary bottleneck in the AI buildout.
Can you walk us through the actual physics here? Why exactly do these new machines run so much hotter than the servers we've been using for the last 2 decades?
The physics basically dictate the entire economic structure of this trade. So in a traditional data center, you have rows of central processing units, or CPUs.
Okay.
They handle standard workloads, sending emails, hosting websites, running basic enterprise applications. They generate heat, but it's entirely manageable.
But an AI server rack is different.
Completely different. It is packed tightly with graphics processing units, or GPUs, unlike CPUs, which process tasks sequentially.
Like one after the other.
Right. GPUs process thousands of calculations simultaneously, in parallel, without stopping. When you have that much concentrated silicon drawing that much electricity constantly, it generates thermal energy at a completely different magnitude.
So you can no longer just blow cold air from an air conditioner into the room.
No, absolutely not. If operators cannot extract that heat immediately, a process called thermal throttling kicks in.
Wait, I want to make sure we get that term right for everyone. Thermal throttling means the processor intentionally slows itself down so it doesn't destroy itself, right?
Exactly. The chip realizes it is reaching a critical temperature threshold, so it artificially reduces its performance to generate less heat.
Oh, wow.
And if it gets even hotter, it shuts down entirely, or the silicon degrades and physically fails.
So if you're a company that just spent hundreds of thousands of dollars on a single rack of AI chips, the very last thing you want is for those chips to slow down just because the room is too warm.
Right. You need targeted, highly engineered thermal management systems. Some of these involve pumping liquid directly to the processor plates.
Liquid cooling, right.
Yeah, and others require massive, high-capacity chillers right on the roof.
I like to visualize it like this. Think about the fan on your standard laptop.
Okay.
It whirs to life when you open a few too many browser tabs. It pushes some warm air out the side, and that does the job. But high-density AI servers require thermal management that looks much closer to industrial-scale refrigeration.
It's an entirely different class of machinery.
So looking at this Modine announcement, does a $4 billion upfront commitment indicate that operators view thermal management as the absolute immediate hurdle to building out this hardware?
It indicates exactly that. The phrase upfront funding to support capacity expansion is
Yeah.
probably the most crucial part of this announcement.
Because they're paying them in advance.
Exactly. The buyers are essentially paying Modine in advance. So
Yeah.
Modine has the capital to physically build the factories that will manufacture these cooling units.
Wow. They're that desperate for the gear.
They are, because they know a shortage of thermal management equipment will halt their entire operation. They can't wait for Modine to slowly raise capital, expand gradually, and just hope the chillers are ready.
They need those specific air handlers and chillers guaranteed by 2027.
Right. This level of financial commitment confirms that operators view cooling as a critical path item. Without it, the facility simply does not function.
And Vertiv and Carrier Global find themselves in a similar advantageous position, right?
Yeah, because the total demand for these specialized systems likely exceeds what any single manufacturer can produce.
I mean, Carrier has decades of experience building massive chillers for skyscrapers.
And that exact expertise is now required for server farms.
Okay, so if an operator is dropping $4 billion just on the air conditioners and chillers, my next immediate thought is, what happens when you try to plug all of those in?
The grid.
Exactly. The local power grid definitely wasn't built for that. And that naturally leads us to the adjacent winners.
Moving from the cooling to the power.
Right. We are moving from the cooling systems to the heavy electrical equipment, power systems, and grid infrastructure. The companies highlighted here are Eaton, ticker ETN, GE Vernova, ticker GEV, and Quanta Services, ticker PWR.
The rationale here relies on direct causality. If data center operators are locking in $4 billion purely for cooling equipment, that implies the wider power build-out is charging forward aggressively.
You don't buy $4 billion of industrial air handlers unless you are equally committed to buying the electricity to run them.
Exactly. The power required to run the cooling systems is immense, and that is stacked on top of the massive power draw of the processors themselves. We are talking of facilities that require as much electricity as a medium-sized town.
I'm trying to wrap my head around what that actually looks like inside the building. The text mentions Eaton has heavy exposure to electrical components and switchgear.
Right.
Wait, before we move on, what exactly does industrial switchgear do in this context? Are we just talking about giant circuit breakers?
Actually, that is a highly accurate way to look at it. Switchgear refers to the centralized collection of circuit breakers, fuses, and switches that protect, control, and isolate electrical equipment.
Okay.
When you are pulling hundreds of megawatts of power from the grid, you can't just wire it directly to the server racks. You need heavy-duty, highly engineered switchgear to step that voltage down, route it safely through the facility, and, well, ensure that a power surge doesn't start a catastrophic electrical fire.
And Eaton is a dominant player there.
Yes, Eaton is a major player in manufacturing that internal electrical routing equipment. But before the power even reaches the building's switchgear, it has to come from the utility.
Ah, which brings in GE Vernova.
Right. They supply the massive, heavy grid equipment, the utility-scale transformers and substations.
And then someone has to actually build it.
Right. Someone has to physically dig the trenches, pour the concrete, and run the high-voltage transmission lines to connect the utility to the data center. Quanta Services provides that specialized labor and engineering.
It's exactly like planning a brand new city. You can't just drop the skyscrapers, in this case, the highly advanced AI chips, into an empty field. You must build the heavy electrical grid, the utility connections, and the internal plumbing first.
That's a perfect analogy.
Which brings us to the actual hardware itself. Advanced cooling is mandatory for installing high-density servers and AI accelerators. So the direct beneficiaries in the hardware supply chain are NVIDIA, ticker NVDA, Broadcom, ticker AVGO, and Arista Networks, ticker ANET.
Yes, the hardware giants.
Now, I understand why NVIDIA makes money selling chips, but I'm struggling to see the direct connection to the headline. How does looking at a contract for air conditioners guarantee NVIDIA's chips are still in high demand?
It acts as a leading indicator for capital expenditure.
How so?
Well, the hardware supply chain operates on very long lead times.
Yeah.
If an investor is trying to determine whether the demand for NVIDIA's processors or Broadcom's custom silicon is sustaining, looking at the infrastructure contracts provides a highly reliable answer.
Oh, because they wouldn't buy the cooling if they weren't buying the chips.
Exactly. No operator commits billions of dollars to capacity expansion for thermal management unless they've already modeled exactly how many processors they intend to buy, install, and deploy over that 2027 to 2029 timeframe.
So the capital committed to Modine actively validates the future demand for the internal hardware.
Yes. And you mentioned Arista Networks, which handles high-speed networking. That is equally vital.
Right, because the chips have to talk to each other.
Exactly.
Huh.
To train a complex AI model, you need thousands of processors acting as a single, unified computing entity. Moving terabytes of data between those processors requires ultra-fast networking switches.
Which I assume also run really hot.
Oh, absolutely. That networking gear processes massive amounts of data, runs incredibly hot, and requires the exact same cooling ecosystem as the processors.
Okay, so we've followed the money from the cooling hardware through the heavy electrical grid all the way down to the processors. But if these equipment manufacturers are taking in billions, someone has to be writing those checks.
And that is where the pressure builds.
Right. That brings us to the losers in this scenario, specifically focusing on cost pressures. Let's talk about the hyperscalers.
The cloud giants.
Yeah. The companies identified here are Microsoft, ticker MSFT, Alphabet, ticker GOGL, and Amazon, ticker AMZN. The text notes this group faces pressure strictly due to rising infrastructure costs as they require land, power, cooling, networking, and backup energy.
The core issue for the hyperscalers, and these are the massive companies operating cloud data centers on a global scale, is the race between physical infrastructure costs and actual revenue generation.
Because it's getting so expensive.
Right. When the cost of a utility transformer goes up, when local power companies charge more for grid access, and when cooling manufacturers require billions in upfront funding just to guarantee supply, the capital expenditure required just to stay in the AI race compounds rapidly.
They're pouring tens of billions of dollars into the physical foundation.
Exactly. And the market pressure stems from the timeline. The hyperscalers must spend this cash today to secure the physical assets, but the software and service revenue that ultimately justifies that massive spending might take years to fully materialize.
Okay, let me offer a specific pushback right there on behalf of the listener.
Sure, go ahead.
When we look at companies like Microsoft and Amazon, they are frequently viewed by the broader market as the absolute undisputed victors in the AI space. I mean, they have the deep pockets, they own the cloud ecosystems, and they control the enterprise customer base. Why categorize these specific, highly successful tech giants as facing potential pressure?
It comes down to Wall Street's expectations regarding profit margins.
Okay, margins.
Yeah. Yes, they are the dominant players with the resources to build these massive facilities. But capital is never infinite, not even for them. Historically, investors love software companies because software has incredibly high profit margins.
Right, once you write the code, it costs virtually nothing to replicate and sell it a million times.
Exactly. But the physical world is expensive, and it is prone to inflation. If the cost of building a single data center doubles because power, cooling, and construction costs are skyrocketing, their return on invested capital compresses.
Ah, so they're spending more to make the same amount.
Right. If a larger percentage of their cloud revenue is constantly being diverted back into the dirt, into concrete foundations, copper wire, and industrial chillers, investors may start to question the overall profitability of the entire AI endeavor. They are characterized as facing pressure because inflation in electrical and cooling equipment directly impacts their bottom line.
That makes a lot of sense when you frame it as the friction of the physical world dragging down software margins.
Exactly that.
And this exact same physical friction impacts the actual data center operators, the companies dealing directly with cost and capacity pressure. The tickers mentioned here are Digital Realty, DLR, Equinix, EQIX, and Iron Mountain, IRM.
Yeah, the landlords, basically.
Right. The text points out that large AI customers can lock in supply through major agreements, leaving others struggling to secure cooling and power at attractive prices.
Right, because data center operators act as the landlords of the digital economy. They acquire the land, build the facility, secure the power and the cooling, and then lease that conditioned space to other companies.
So what's happening to them right now?
The dynamic playing out right now is a fierce, zero-sum competition for scarce physical resources. When a hyperscaler locks up Modine's manufacturing capacity for 3 years with a $4 billion deal, the smaller or independent data center operators find themselves pushed to the back of the line.
They just can't get the equipment.
Right. If an independent operator wants to build a new facility today, they might discover that the waiting list for an industrial chiller is 2 years long, and the price has increased substantially.
So even giants like Digital Realty and Equinix face this specific headwind.
They do. They have tenants begging for space. But if the cost to provision that space with heavy power and thermal management rises too fast, their profit margins shrink.
Now, I see Iron Mountain on this list, and I usually associate them with those secure underground caves where companies store boxes of physical paper records. Why are they included in a discussion about AI data centers?
That is a great observation. Iron Mountain is actually actively transitioning its business model from physical document storage into operating digital data centers.
Oh, I see.
Their inclusion here highlights a broader reality. Newer entrants, or companies pivoting their business models, will be judged strictly on their ability to execute construction and secure equipment in a highly constrained environment.
So they have to prove themselves.
Exactly. If the established players are struggling to get chillers and switchgear, a transitioning company like Iron Mountain has to prove they can successfully navigate those exact same supply chain bottlenecks.
So we've covered the tech sector thoroughly, but money flowing into AI infrastructure must come from somewhere. Investment capital isn't just created out of thin air.
No, it has to rotate.
Right. This brings us to the capital rotation and how legacy industrials are positioned as losers in this specific dynamic. The text points to legacy industrial and auto supplier names with less AI exposure. The tickers are BorgWarner, BWA, Autoliv, ALV, and Lear, LEA.
Yeah.
Investors are favoring companies exposed to AI infrastructure, power, and cooling. This causes a rotation inside the industrial sector.
This is a classic demonstration of opportunity cost playing out in real time within the financial markets. The industrial sector is vast and diverse.
It covers a lot of ground.
It does. It includes companies making airplane engines, automotive seating, heavy construction machinery, and, as we've discussed today, data center cooling systems. Investment portfolios, whether managed by retail investors or large institutions, only hold a finite amount of capital.
Right, there's a cap.
So when portfolio managers see guaranteed, multi-billion-dollar contracts flowing toward companies like Modine, Eaton, and GE Vernova, they naturally want to capture that growth. To buy those specific stocks, they have to sell something else to free up the cash.
I think we need a clarification here, though. How should an observer view a company that is maintaining its standard operations, hitting its internal targets, and making a profit, but becomes a quote-unquote loser simply because investment capital is rotating toward newer technologies like thermal management?
That requires separating the underlying business operations from the actual stock performance. BorgWarner, Autoliv, and Lear are primarily automotive suppliers. They manufacture transmissions, airbags, and automotive seating.
Which people still need.
Exactly. Their underlying businesses might be performing adequately according to their traditional internal metrics.
Yeah.
They certainly aren't losing airbag contracts to Modine.
Right.
However, in the context of the stock market, performance is always relative. If the automotive sector is experiencing slow, predictable, cyclical growth, while the AI infrastructure sector is experiencing explosive, contract-backed growth, the investment capital will ruthlessly abandon the slower vehicle.
It just chases the highest return.
Precisely. For the observer, it is a stark lesson in relative valuation. A company can be profitable and well-managed, but still see its valuation compress because the market has found a faster-growing alternative within the exact same broader sector classification.
So the designation of loser here applies strictly to stock performance and capital allocation.
Right, not necessarily operational failure on the factory floor.
That distinction between operational failure and capital reallocation is vital for understanding how broader market mechanics actually operate. It shows how interconnected these sectors really are, even when the underlying products, airbags versus data center chillers, have absolutely nothing in common.
Yeah, the common denominator is the investment capital itself.
Exactly.
And the rotation we are discussing today highlights the sheer intensity of the AI infrastructure build-out. When billions of dollars are committed to cooling systems years in advance, it serves as a massive gravitational pull, drawing capital away from traditional manufacturing and automotive supply chains. It basically redefines what an attractive industrial asset looks like in the current market environment.
Let's leave you with a closing consideration based purely on the text we have examined today. Consider how a single utility cooling forces a complete reevaluation of industrial stocks.
It's fascinating.
It really is. A traditional manufacturing company securing a multi-billion-dollar tech infrastructure deal blurs the lines between what we consider an industrial stock and a tech stock. The physical heavy metal machines managing the heat have become entirely inseparable from the digital algorithms generating the heat. You just can't invest in the software without understanding the plumbing.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
We appreciate you joining us for today's discussion on breaking news to trading moves. Until next time, keep analyzing the headlines.